Hey, good morning, everyone. Marty Mazzora here, 6th of May, 2023, with your weekly economic update. I can keep this one brief. Yesterday, I took 20 minutes on the market update video and actually got into some of the details of the current economic setup. Clients, if you didn't get a chance yet, please take that one in. I think that's an important presentation with some important observations. In front of you is that PWA index, 45 data points. It's done a good job for us in terms of signaling when things are somewhat precarious relative to the economy. When we go below zero, that tells us that odds favor recession going forward. Created the index back in the summer of 2017. When we back tested it, it did do a very good job of signaling that recession is coming, within a few months of us going to a negative reading. That was August of 2019, before the spring of 2020 recession. Back then, we had no idea that coronavirus or COVID was going to be what it was. Essentially, the fact that that was believed to be the cause or advertised as being the cause of, again, our data was saying it was coming anyway. But the fact that COVID occurred allowed for the dynamics that led to this, and that was just massive amounts, trillions of dollars of stimulus hitting the economy and not allowing, frankly, for the normal purging of excesses that recessions do. That's the important part of recessions, of the business cycle, if you will. And so obviously, as we wring that back out of the economy, or as it gets wrung out of the economy, it's going to create interesting dynamics in terms of timing of the cycle, severity of certain stages of the cycle, and so on. So right now, though, when we stick to the nitty-gritty, if you will, it says that, at a minus 31, up 2 points from last week, that recession is a highly likely event within the next, we'll say, several months. Of course, this ultimately could turn out to be a false signal. It could turn out not to come true if conditions start to move back in a better direction on a sustainable basis, and that would be great. But that's not our base case for this reason and an abundance of other data that we parse day in, day out, week in, week out. So despite what you see when you're out wandering around the streets and seeing a lot of activity, that kind of makes sense too, and you'll kind of pick that up when I show you the results of the ISM surveys this last week. Just starting with retail sales, the numbers everybody's interested in come out monthly. Redbook brings their data out weekly, and as you can see, in terms of growth rate, it just continues to decline, and you can see what it tends to do during and leading into recessions. So pretty dramatic drop-off from pretty high levels. Remember that distortion I was talking about. Trillions of dollars getting spent in the economy, in the retail sector, and then coming off of that now. Auto sales actually saw quite the pop here this last month. Borrowing from Peter Bookfar's weekly narratives, April auto sales totaled 15.9 million. Above the estimate of 15.1 and up from 14.3 in April. Wards said, higher interest rates, elevated prices, and fear of recession undoubtedly are pushing some consumers out of the market, but pent-up demand, especially from fleets, I emphasize, increased availability, and an economy still seeing job growth and wage increases are offsetting the headwinds. Incentives are rising from rock-bottom lows, which helps, but those gains are more in line with what would be expected as inventory rises from historic lows rather than from automakers simply reacting to consumer pullback. So let's just say there's some nuance to be considered underneath those numbers. Weekly jobless claims continue to look recessionary to me on a near-term trend basis. Again, still, historically not too elevated, but it's all about the direction and the rate of change. And here, draw some lines heading into previous recessions. Flags need to go up when we see this kind of movement in weekly jobless claims. Okay, so the jobs data 253,000 was better than expected. However, 143,000 lower in revisions for the previous 2 months. Unemployment rate, which comes from the household survey, dropped to 3.4%. Average hourly earnings are rising at a 4.4% annualized clip, 0.5% on a month-on-month basis. The quits rate, which I talked about already the other day, is dropping to 2.5. Quits rates tend to drop as the economy begins to wane. Could say people are valuing their jobs more when the quit rate is dropping, still at a pretty elevated rate historically. You can see that job openings are beginning to roll over, still at historically high levels. The Fed wants to see this come down. Participation rate stayed the same at 62.6%, and the U6 unemployment rate, which includes everybody, discouraged workers, they're part-time workers who would prefer to work full-time, they get counted, for example, in the U6. And here you have just a historically low unemployment rate. You hear people saying all the time, you can't have a recession when the jobs data looks so good. And that's true until almost the moment you don't, right? Really low unemployment rate until it began to rise, right? Then we have recession. Here we are heading into the great financial crisis, just starting to inch its way up. Boom, we're in recession. Prior to the tech bubble bursting, then boom, we're in recession and going into the early 90s recession. Don't go back far enough because some of this data just doesn't take us back that far. So again, we just need to be very, very sensitive to the moves. And when you have a few weeks or a few months of rising jobless claims like I just showed you, and then of course unemployment, it just kind of checks that box with regard to high recession risks going forward. Another thing underneath the surface of the jobs data, I wanted to show you temporary jobs, which has dropped for 3 months running. So temp jobs are considered to be forward-looking as pressures build and business picks up and companies maybe aren't ready to make that commitment with the benefits and everything that goes with it to a permanent employee, they'll hire temps, right? So you see, coming out of recessions, you see big pops, right, in temp hiring, right? Big time out of here. Well, heading into recessions, right, coming out of expansions, this is what you tend to see. This is what we're seeing now. This is what we were seeing. Remember, our indicators were saying back in here that recession's probably coming, and sure enough, it was showing up here as well. Here we are heading into the great financial crisis. Here we are heading into the tech bubble recession and so on. So folks, again, I get it, the bulls and people who want to be optimistic, and we don't want to be either. We want to be realistic about the conditions that we see and what they're telling us. Right now, under the surface of the jobs data, we're seeing stuff that's concerning. And maybe that's why the market rallied so hard, as they think that the Fed, will back off, that maybe it wasn't such a robust jobs number. So time will tell. We'll, of course, keep you posted. So the ISM's, Institute for Supply Management, Purchasing Managers Indexes, the white line is the manufacturing sector. The yellow line is the services sector, right? This is what I was talking about earlier. So here you have manufacturing rolling over into recession prior to the early 2000s recession. And it was a few months later, and right during when the recession officially started, that services rolled into recession, right? Just barely ahead of the 2008. It kind of happened all at once. Looks like here you see manufacturing peak before you see services peak. And then they both kind of went into near or into recession territory about the same time. Services bounced back out of it first. Manufacturing followed, then it kind of switches places. Here you see manufacturing roll over briefly in recession territory during that very tough period in 2015, 2016. Services held up. And then here we are prior to COVID, manufacturing rolling over again before we knew anything about COVID. And then, of course, services followed in there. And then, so here we are, folks. So here's the manufacturing space. And here's everybody still out spending money on services. Right in here, by the way, when we backtest our index, it was not giving us a recession signal. And we weren't forecasting recession just with the work we were doing back in here anyway. So we were telling clients this is a tough period for markets, but general conditions say that we should stay the course. Same thing when the market corrected by 20% in 2018. Our general conditions back up in here, or at least our assessment of general conditions, was still pretty bullish on the economy. Wasn't the case coming into the summer of 2019. Good thing, because we were able to mitigate more than the lion's share of the COVID decline. And so here we are again, folks. So this and all the other data that we talk about explains why we're playing some defense right here with portfolios. Something else to point out inside those ISM surveys, and this is pulling out the prices component. This is for manufacturing. This is for services, up just a little bit. So above 50, just like the indexes themselves, above 50 denotes growth or expansion. Below 50 denotes contracting. So when we're above 50 on prices, that means that prices are rising. Compared to where we were here, they're rising. This is just they were rising at a faster pace, right? So prices still going up while we see some real recessionary conditions. It makes for a tough road to hoe for the Fed. And then lastly, just to look at copper. So copper has a nickname, Dr. Copper, because it's so economically sensitive. Well, copper is also the most ubiquitous, the most needed metal element, if you will, in the whole renewable energy transition. Copper's huge when China stimulates in their traditional way of doing it, and that's with massive infrastructure spending and so forth. So copper has come notably off the boil here, but it's still at historically very high levels. I just listened to a half-hour presentation on the copper space going forward, and doesn't really look too bad. I'm concerned about metals and miners, etc., because of our recession call going forward. But when you look under the surface and you look at the fundamentals, they're not bad. We are uber bullish copper past whatever the economy has in store. Early March, I believe it was March 6th, we cut our metals miners exposures in half. At the time, that position was up 20%. It's down 2% now on a year-to-date basis. We also cut materials a bit, and we cut our industrials exposure. Among the things we added to were consumer staples, when that turned out to be a good move, and healthcare, which I believe is off a bit even from then, but not nearly to the extent that the things that we cut are. So ironically, these are things that we are really, really bullish on longer term going forward. But to be hopefully smart and tactical, which we need to be, I think, particularly in this environment, the near to intermediate terms said there's going to be some pressure on those areas. Still own them just in case the bulls are right and we don't get that big drop off in the economy. But, time to be better balanced, time to play some defense, as I keep saying. So folks, that's a good one to end on. I'll leave it there. Went a little longer, I think, than I had planned, as usual, but I appreciate you sticking with it. Hope you have a great weekend. Talk to you next week. Take care. Bye-bye.